Ladies and gentlemen, good day and welcome to the Oriental Aromatics Limited Q3 FY22 earnings conference call. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. I would now like to hand the conference over to Mr. Anuj Sonpal from Valorum Advisors. Thank you and over to you, Mr. Sonpal.
Thank you. Good afternoon, everyone, and a very warm welcome to you all. Wish you everybody a happy new year, and I hope everybody is well. My name is Anuj Sonpal from Valorum Advisors. We represent the investor relations of Oriental Aromatics Limited. On behalf of the company, I would like to thank you all for participating in the company's earnings call for the third quarter of financial year 2022. Before we begin, let me mention a short cautionary statement. Some of the statements made in today's earnings call may be forward-looking in nature. Such forward-looking statements are subject to risks and uncertainties which could cause actual results to differ from those anticipated. Such statements are based on management's beliefs as well as assumptions made by and information currently available to management. Audiences are cautioned not to place any undue reliance on forward-looking statements in making any investment decisions. The purpose of today's earnings call is purely to educate and bring awareness about the company's fundamental business and financial quarter under review. Now let me introduce you to the management participating with us in today's earnings call and give it over to them for opening remarks. We firstly have with us Mr. Dharmil Bodani, Chairman and Managing Director, Mr. Shyamal Bodani, Executive Director, Mr. Parag Satoskar, Chief Executive Officer, Mr. Girish Khandelwal, Chief Financial Officer, and Ms. Kiranpreet Gill, Company Secretary. Without any further delay, I request Mr. Dharmil Bodani to give his opening remarks. Thank you, and over to you, sir.
Thank you so much, Anuj. Good afternoon, everybody. It is my pleasure to welcome you to the Quarter 3 earnings conference call of Oriental Aromatics Limited. Firstly, I'd like to wish every one of you a happy new year, and I hope all of you are keeping safe and healthy. Now, talking about the performance during the quarter, we witnessed strong demand across all product categories, resulting in a better top-line growth compared to the same period last year. Even though the volumes were slightly lower in the quarter due to a planned shutdown taken at our Bareilly site for 20 days, the production numbers and sales numbers at all plants crossed pre-COVID levels for a 9-month period of financial year 2022. The margins and profitability continued to be under pressure due to significant increases across all input costs. However, these are showing signs of stabilization and in some cases have started showing a downward correction as well. The company has successfully passed on these price increases to most customers. The average rate per kg of products sold has also increased as compared to pre-COVID levels. This quarter also marked the successful commissioning of our dedicated specialty aroma ingredients plant at Vadodara, and the validation of this plant is continuing as scheduled. The commercial batches from this validation process are being successfully sold to customers, and the quality has also been accepted globally. The company has also successfully completed the capacity expansion project in the Bareilly plant, increasing capacity of one of the products by almost 70% through process re-engineering. Validation process for this expansion will continue in quarter 4, and top-line contribution of this expansion will happen in FY23. Now I request Mr. Girish Khandelwal, our CFO, to give the financial highlights. Thank you.
Thank you, Dharmil. Good afternoon, all. On a consolidated basis, in Q3 FY22, the operating income for the quarter was rupees 206 crore, which was an increase of approximately 7.9% on a year-on-year basis. Operating EBITDA reported was rupees 16.2 crore, which decreased by about 70% on a year-on-year basis. Operating EBITDA margin stood at 7.87%. Net profit after tax reported was rupees 8 crore, which was a decrease of about 78% on a year-on-year basis, with PAT margins reported at 3.89%. On a consolidated basis for the 9 months ending FY22, the operating income for the quarter was rupees 665 crore, which was an increase of approximately 36.5% on a year-on-year basis. Operating EBITDA reported was rupees 70.4 crore, which was a decrease of about 42% on a year-on-year basis. Operating EBITDA margins stood at 10.57%. Net profit after tax reported was rupees 43 crore, which was a net decrease of about 46% on a year-on-year basis, while PAT margins were reported at 6.4%. Thank you. With this, we can now open the floor to questions and answer session.
Thank you very much. Ladies and gentlemen, we will now begin the question answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Dhwanil Desai from Turtle Capital. Please go ahead.
Hi, Dharmil. Good afternoon.
Good afternoon.
And wish you a very happy new year to you and entire team.
Thank you.
So 3 questions. The first one is, Dharmil, we've been talking about different segments, all 3 segments in previous calls. And I know that you may not want to discuss specific numbers with respect to each segment on margin side, but at least can you give us some sense in terms of packing order on the gross margin across all 3 segments, which is the highest and which is the lowest?
So I'll just I'll let Parag answer this question, and I'll add on if there is needed.
Sure. So, Dhwanil, like Dharmil has mentioned in his opening remarks, that the demand for all the product categories that we operate out of remains strong, and we had margin pressures because of the input costs going up, and that had an impact on the margins. And that was primarily the impact. However, I can gladly say that most of the price increases have now been successfully passed on through the customers, and in the coming quarters we hope that we will have better gross margins. And like we always have been saying in our investor calls, that assuming that there is a stable pricing scenario, we still continue with our deliberation that our long-term earnings are targeted between the 15 to 17% EBITDA margin levels.
Yeah, that I get, Parag. My question was more on a steady state basis between camphor, FNF, and aroma chemical. Where is the higher gross margin and where is the lower gross margin? If you can elaborate on that.
So you can mention the fluctuations in the camphor pricing, Parag.
Correct. So primarily, if you probably are looking at a sectoral, we have always maintained that all the 3 sectors that we operate out of, we have more or less similar margin expectations. Having said that, the camphor prices, especially in the off season, are a little on the subdued side, and because of which, the margins are a little compromised on the camphor side in this quarter. However, going forward, we probably would be, because we are also kind of achieving the pass-through, we should be getting better margin realization.
Correct. So hence the answer to your question is there really isn't a pecking order. It's across the 3 verticals. This is the gross margins that we as a company focus on. And it's not like the FNF would give us, for example, 20% and camphor would give us 12%. There is no differentiation. We look at the business in totality.
Okay. Got it.
And just to add one quick point to Dharmil, rather than specifically saying, but normally if you have your aroma ingredient prices going up and better realization, there is a little bit pressure on the fragrance side because you are not able to pass it through quickly, and the other way around.
Okay. Got it. My second question is, so I mean, our mix currently is almost equal between all these three segments, and our incremental capacity, at least in Baroda, is coming mostly on aroma chemical side. And we have a new greenfield capex lined up at Mahad. So after that capex, I think we have asked this question before. There is some confusion. I think in one of the analyst interaction, it was mentioned that aroma chemical proportion will increase after capex, and in I think another one, it was that the product mix will remain same across all these segments. So can you clarify on that? How will it pan out after expansion?
So post capex, depending on where we end up with the actual numbers, we definitely feel that the aroma chemicals, which will be broken up into bulk and specialty, along with the camphor business that we will continue to be in as a vertical, we believe in the next 2 years, we believe that the aroma chemicals, specialty, and the camphor division would probably get to a much larger percentage than the flavor and fragrance. Today, I'm not in a position to tell you that because we have the fragrance and flavor division also growing. So I think we'll wait to see what the eventual mix is going to be.
Okay, got it. And my last question, updates on both hydrogenation project capex and greenfield expansion.
Yeah, all right.
Sure. So on the hydrogenation project, like we have been mentioning that the investment is roughly between 140 to 150 crores. We were targeting commissioning of the plant by June 22, but this Omicron and a little bit of disturbance is here. Although the work is going on at full speed, but we are kind of hoping that we commission the plant by end of Q2 22-23 or beginning of Q3 22-23. So it should probably be, it should be hitting the top line from H1 2023 is what our guesstimate is on hydrogenation. On Mahad, we are still awaiting our environmental clearance. However, like we have mentioned in our earlier calls, that we have done all our homework in terms of the process reengineering, the utility management, the master planning, etc. And so we still stick to the plan of commissioning the first phase of Mahad in the financial year 22-23, preferably Q3 or Q4.
Great. Thanks. I have more questions. I'll come back in. Thank you.
Sure. Thank you.
Thank you. The next question is from the line of Manish Podar from Nippon India. Please go ahead.
Yeah. Hi. Thanks for doing the call. So primarily, a few questions. First is, do you have any inventory which is at higher cost now, or you're purchasing largely on spot? Just if you could explain that.
Can you repeat the question, please, Manish?
So I'm just trying to understand. Do you all have any higher cost inventory on books still?
Okay. So
can there be a mark-to-market, loss or gain? That is what I'm trying to understand incrementally.
Okay. So, Manish, we currently have inventory because the raw material prices, the way they are positioned today, they have stabilized, but they have stabilized at these higher price points. So, and that is the reason why, we have gone and renegotiated our new orders with our customers at a higher price. So, if you want to summarize it, we have the inventories which are of the higher costs, but they are commensurate to the price increases that we have taken from the customers. So we don't foresee a loss there. However, we still are living in uncertain times where, you've suddenly seen a spike in the oil prices and then everything goes in a reset mode. So we are on a wait and watch strategy. We are micromanaging our inventory management on the raw material side, and every raw material is being treated, monitored differently.
Okay. And what sort of price increase would you have taken at the blended level sequentially?
So I think, like I said, that when you have a basket of close to 200 aroma ingredients and more than a few thousand fragrances and flavors, it is really impossible to generalize. But I think wherever we have seen that, we had to get a price increase to be sustainable, we have done that. So I would just like to summarize it saying that the pass-through has successfully happened across all the divisions.
No, because let's say if sequential revenue decline is roughly 11%, and let's say even if you have taken, it's a high single-digit pricing growth on portfolio level, the volume decline seems sharper. So is there any impact on the demand overall? Let's say, just want to get some sense of that, because generally, Q3, Q4 are largely similar run rate numbers. Or let's say better actually. Q4 is better than Q4 in some instances. So just want to understand that.
Correct. So I think
the pricing, performance has been lagging. So just want to understand the reason behind that. Sorry.
Sure. So I think you probably will have to look at the current Q3 and Q4 in a different perspective compared to the last few years. Because we actually got into Q4 carrying this enormous baggage of extremely high input costs, which the customers were not ready to renegotiate in the middle, and so they were pretty convinced.
Which is our Q3 when you say Q4.
Yeah, correct. And which is where we have kind of, like I said, that we have passed it on to the customers in Q4. So in terms of demand, I don't see, because of the price hikes, any drop in demand, if that was the question that you asked for. In terms of transferring the prices, we have done that. We are also monitoring the raw material situations because, the raw materials can go haywire anytime, and because of external factors which are beyond our control. So yeah, we've done all the necessary things that needed to be done to kind of course correct.
So if I get it from the two questions, demand is fairly steady. You've taken the pricing inflation for the inventory plus, let's say, the cost inflation which you've witnessed. Is that how you would summarize it?
Absolutely.
Just one last one then. Let's say in terms of the cost structure, given the two units, let's say Bareilly and the Baroda thing coming into play in Q4, this quarterly run rate of 50 to 55 crores cost which you have, would that be the steady state number which one should pencil it going ahead?
Girish, can you explain what exactly is this cost number? I mean,
what is the?
I'm just trying to add these three numbers: manufacturing cost, staff cost, and other expenses. Okay. Those are generally 52 crores this quarter and 50 crores last quarter. So I'm just trying to understand, other than the cost of goods sold.
Same range. Yeah.
Yeah. So the answer is it will be in the same range.
Yeah.
Correct.
Okay. So fine. That's really helpful. Thank you so much.
Thank you.
Yeah.
Thank you.
Hello.
Yeah, I'm done. Thank you.
Thank you. The next question is from the line of Rahul Jayantilal Jain from Credence Wealth. Please go ahead.
Hello. Am I audible?
Yeah.
Thanks for the opportunity. So just to get a sense, you mentioned in the presentation and also in your opening remarks, with Bareilly plant being shut down for 20 days. So typically, what could have been the impact of this in terms of, say, a revenue, had this plant shutdown not been taken?
Correct. So Parag and Girish, when you answer this, also explain the consequences of this shutdown in terms of long term, that it will not happen in maybe the coming financial year.
Sure, absolutely. So primarily, Girish, correct me if I'm wrong, but the impact of the additional inventories that we would have got, since most of our plants are running at max capacity in Bareilly, would have been around, the incremental top line would have been around between 27 to 30 crores?
Right.
Right? Okay, so that's
25, 27 crores.
Yeah.
Right.
That's point number one. Point number two, like Dharmil said, this shutdown was a very strategic shutdown because we wanted to kind of update our boiler systems in Bareilly, which kind of prevented us doing a major capex there and enhancing the life of our boilers. So it's kind of something which is not going to be more repetitive, and it was taken once in a while. Otherwise, normally our shutdowns are anywhere between 5 to 7 days.
Sure. So this will help you in saving some cost going ahead?
Absolutely, because my boiler systems are now producing steam at a much more efficient rate than what they were doing in the past.
Sure. Secondly, with regards to Bareilly expansion, if you could share some details about which product we expanded. And correct me if I'm wrong, Bareilly majorly would be a camphor unit?
So Bareilly is primarily driven by the terpene chemical. So Bareilly has camphor as one of the product blocks, and along with that you have a wide range of other terpene chemicals as well. So this particular expansion that we have successfully completed in this quarter is a process reengineering expansion and a brownfield project, where without getting into the micro, there's one product group where we have now implemented a 70% expansion, and this product group, especially in the context of floor cleaners and disinfectant, is a very significant product group. So we are very confident that once this is passed on to the top line, we will be in a position to achieve an incremental revenue of at least 35 crores every year because of this expansion.
Sure. And the capex would be around 15-20 crores for this?
No, this was because it was process reengineering and it was brown. The capex was, I think, between 4 to 5 crores.
Achha, that's it. So
yeah,
4 to 5 crores will result in additional top line of about 35 crores.
Correct.
Sure.
Yeah, but that's not our normal run rate for the amount that we do capex, because that is normally between 1.5 to 1.7.
Sure.
Right.
Yeah, I get that. And lastly, sir, with regards to margin, apart from the initial remarks and the previous participants' questions, do we get to understand that most of this commodity price inflation, raw material inflation have been passed through and the entire pass-through has been done? So hopefully going ahead, say the next quarter onwards or maybe another quarter, should we revert back to stable margins as what we have been always talking about? Are we done through with all the price increases and all those acceptance has been done by December is what I need to understand.
Correct. So I think, Rahul, I think it's a very important question, and I think, during some stage of the call, we would have probably addressed this question. Like I reiterated in my earlier answer, that, we have always maintained 15 to 17% EBITDA margins based on a stable pricing scenario and long-term, and our long-term earnings strategy. So, that's the reason why, if you remember our earlier call, one of the earlier investor calls, where our EBITDA margins had touched 24%, on that call, Dharmil had very specifically mentioned that 24% is not sustainable. And hence, when we are seeing these kind of EBITDA margins for a quarter, we are very confident that with our R&D pipeline and with our commitment in terms of being sustainable on all fronts of business, this 8 to 9% also is not sustainable. So, we will eventually, when we reach a stage of stable pricing, come to the EBITDA margins of between 15 to 17%. Last time, Girish, correct me if I'm wrong, we had such levels seen in 2012, because we have seen them. Yeah. 2012 is when we had seen such levels coming down, which again were primarily driven by raw material prices going up substantially. And they lasted for 2 to 3 quarters, after which we again came back to our normal run rate. So, I think in the chemical industry, especially the last 1 year, has been very unprecedented across all inputs. And so we need to be a little patient, and I'm sure we will achieve those numbers going forward.
Sure. And lastly, with regards to the capex getting over in next 2 years, and Dharmil did mention, and you also mentioned, aroma chemicals and specialty and camphor put together will be higher proportion than F&F. So you are talking about stable margins of 15 to 17% given the business as we speak today in terms of the divisions today or the segment-wise revenues coming in today. But going forward, say after 2 years when the expansions are done, based on the product profile, based on the product classification, is there a possibility of improvement in margins because of better product mix coming into play? Is there fair assumption?
Right. So I'll take this question, Parag. So I think we would like to stay with the same guidance. We are not revising it at this point, and you know, the 15 to 17% that we keep referring to is also based on the new plants and the new products. You know, it's a continuous process of the additions also.
Yeah.
Sure.
Does that
Thank
answer
you
your
so much.
question? Yeah. Okay.
Sure.
Thank
Thank
you.
you so much. Wish you all the best.
Thank you.
Before we take the next question, a reminder to all the participants to please limit your question to 2 per participants only. You may rejoin the question queue if you have a follow-up, as we have many people waiting for their turn. The next question is from the line of Ankit from Bamboo Capital. Please go ahead.
Yeah, thanks for the opportunity. On the Mahad Capex front, you know, we have yet not received the EC approval. So are we sticking to the phase 1 starting by end of December this year, or do you think there might be some delay of a month or two?
Parag, you just answered it.
Sure. So I've just kind of answered it a while back that although we see, but we are doing our homework at the back end in terms of process engineering and everything else. So we stick to the same timelines, and we'll probably evaluate it going forward.
Sure. So currently in terms of capex, the single unit plant at Baroda is done. The hydrogenation plant is expected to commence operations max by Q3 of next year, and Mahad, at least phase 1, should start maximum by Q4 of next year. Is that the right assumption?
Correct.
Okay. And apart from that, any other capex which is lined up?
So, like I said, that nothing that is currently on the cards, and
Beyond
I
what
think,
we've said, yeah.
yeah, and we continuously looking at what's happening around and looking for opportunities.
Okay. And Baroda post this hydrogenation plant also, if I remember in last call, you stated that we still have sufficient land available for future expansions as well.
Absolutely. Absolutely.
Okay. Okay. And one question on the margin side, you know, we on the gross margin front, we have seen that, you know, Q2 our gross margins have improved compared to Q1 of this year, and Q3 our margins have improved compared to Q1 of this year or Q2 of this year. So, you know, I think the margins on the EBITDA side have been largely hit because of the shutdown at the Bareilly plant for 20 days.
I think it's a fair assessment, but there are a lot of other. I mean, it's not just the primary reason. I mean, it is one of the reasons, but there you also still had the impact of the high cost inputs inventories which we had, and you know, we were not able to kind of pass through all those price increases to the customers in Q3. However, you know. So yes, it is one of the reasons, but not probably the only reason.
Okay, so let's say in next quarter or maximum by Q1 of next year, should we expect that our gross margin should be back to our origin or long-term average gross margins of around 36-37%? Is that the right assumption? If you know there is no major changes in raw material prices or shipping cost prices.
I think it's fair to say that we are doing all the things right to really achieve those numbers. But like I keep reiterating, there are too many external factors which keep hitting the whole strategy. So we'll have to wait and watch. But yeah, if everything goes like I said, if there's a stable pricing regime going forward in the next 2 quarters and a stable RM availability situation and no further hiccups in terms of costs, we should be good.
Sure. Thank you so much. Thanks.
Thank you.
Thank you. Before we take the next question, a reminder to the participants again. Please limit your question to 2 per participants only. The next question is from the line of Rajat from iThought Finance. Please go ahead.
Hi, am I audible?
Hi Rajat, yes you are.
Hi, thanks. So sir, I was just saying that our sustainable or normalized gross margins are 36 to 37%.
Rajat, can you repeat the question, please?
Are we saying that our normalized or sustainable gross margins are 36 to 37%?
Girish, can you answer this question?
Yes. So that's actually our long-term target to achieve the 15% EBITDA should be the margins should be in the range of 36%. So this is the only our target.
Understood. And this margin profile will not change despite the new CapEx coming in, right? Or you expect this to change?
No, our guidance stays the same.
Yeah.
And just to probably add on to what Dharmil said, Rajat, all these expansions are going to come in waves or phases. So, it's not going to be that we are going to be out of products for a long period of time, then suddenly the tap opens for all the products.
Correct.
And that's why you're going to have phase-wise inclusion of products, like we have just commissioned one plant, then these other. So that will give us the opportunity to really stabilize one product. It starts contributing to the top line, bottom line, and we move to the next one.
Sure. And in terms of the CapEx, I think we have a plan of overall 200 in the Mahad and maybe around 170, 180 crores in the existing, including hydrogenation. So how much of that has already been spent, sir?
Girish?
Sorry, can you repeat your question?
How much of the CapEx have you already done in the last, as per the September balance sheet?
How much have you drawn is the question, Girish. How much have you drawn in terms of CapEx for the new expansion?
So see, we have drawn down the 30 crore term loan for the new expansion at Baroda, but for Mahad we have not yet taken any debt.
So we will as soon as the C-Star permission comes through, or we find that we are ready in the next, or probably in this quarter with ordering the plant and machinery. So we are expecting to start the drawdown for Mahad in this quarter. And the other expansion, as he mentioned, there's been part internal accrual, correct, Girish? And part we've taken the term loan of 30 crores.
Right.
Right. So do you have the internal accrual number approximate that we've been?
Yes. So approximate we have incurred 48-50 crore till now, and out of that we have taken 30 crore from the.
Right. So total we've what was the total number you mentioned? 48.
48 crore approx.
So about 18 crores we have invested from internal accruals.
Yes.
So basically,
that's breakup for now.
Sure. So around 30 crores we have already. I mean, how much CapEx are we going to spend in the next 3-4 quarters?
So I think if you do the math based on the numbers that we've given, if we've done about 48, which is 18 through internal and 30 through the term loan, I think Parag, Girish, we should be at a number of what? It's
in next 3-4 quarters you are asking, right?
Yeah, next 3-4.
Yeah. So next 3-4 quarters our capex we would incur around 150 to 200 crore.
Correct. Because that's when the activity in Mahad will start.
And how much time does it take to ramp up the new capex?
It would go plant-wise because we will be focusing the first round of capex on on our specialty aroma chemicals vertical. So like Parag has mentioned, it would be phase-wise. So we would see the first plant commissioning in quarter 3, latest quarter 4 of 2023. Correct, Parag? That's
correct.
Right.
Yes. Yeah. So, I mean, Rajat, like you said, that the ramping up time, since we are into the generic specialty aroma ingredient space, and thanks to our fragrance division, we probably are aware of the market. I think we probably would not be looking at a substantial ramp-up time in terms of most of the products that we're going to launch.
So you mean you can ramp up pretty fast?
Sorry?
So do you mean to say you can ramp up pretty fast?
Yeah, absolutely. And I think the good example of that is the new plant, the new standalone specialty chemical plant, which I mentioned in my opening speech that we've commissioned. Not only is the validation of the batches going on, but those validated batches have been approved by customers globally, and we've already started shipping in, I think, the month 1 of the commissioning of the plant.
Correct.
Okay. Thank you, sir.
Thank you. Before we take the next question, a reminder to the participants again. Please limit your question to 2 per participants only. The next question is from the line of Bob from Falcon Investment. Please go.
Hello. What percentage of your chemicals do you sell on the spot market?
Parag?
What percentage of the chemicals do we sell in the
Spot market.
Oh, okay. So if you look at probably camphor as one of the product, I think that's for the puja and for the religious purpose. Whatever is sold in India is mostly on spot or on a 15-day price kind of a situation. And apart from that, for the rest of the products, we probably are looking at a 70-30 or a 75-25 breakup between 75% being the one which is kind of on the RFQs or on contracts, and the remaining 25 to 30% is on spot.
Correct. So Parag has referred to the bulk aroma chemicals and the specialty ingredients.
Correct.
On the flavor and fragrance side, we always manufacture made to order. So there is no spot selling whatsoever on the fragrance side.
Correct.
And the flavor side.
Right. So that would give you more leeway to match the prices with your input costs, right, over the course of the year at least, if you are on a contract basis.
Yes and no. But I need to understand the question more. Are you talking about which vertical?
Okay, all right. Let me just elaborate. So what I'm saying is, because we have seen a lot of volatility in your margins.
Yes.
Right. There's extreme volatility. And also, given the fact that you're undergoing all this capex, there needs to be some certainty as to the margins. Otherwise, how are you going to come up with even a return on investment on your projects?
Correct. So that is why we've maintained the 36% gross margin guideline, because, like you have very correctly said, there will be a product acquisition cost. So we are basing the specialty chemical prices today that prevail in the market based on what we would come up with our new capacity for the same molecule, which is an off-patented generic molecule. We've taken the pricing structure at 36% to basically see at those gross margins whether we are competitive or not, and then decide whether we want to go into that molecule and build a plant. So all the expansions that we are looking at, we are going to stay in that ballpark region. Although I will add that there will be a product acquisition cost. So when we do come into the market with this generic material, there may be a very large price differentiation between the inventor and us, or between the inventor and maybe another manufacturer and us, to get the product accepted faster by our customers. And I think then in time it will start stabilizing. But those product acquisition costs will not be lower than a 36% gross margin for us to be able to achieve the 15 to 17% EBITDA guidelines.
Right. And your customers you already have contracts with these chemicals.
Yeah, so the way it works is, the aroma ingredients and the specialty, the bulk and the specialty, are used by the flavor and fragrance industry globally. So the process is that, say, we finish our pilot and commercial. So at commercial, we would pick two anchor customers that we would start working with to get the samples approved that come through through pilot. As they come through pilot, we give them 3, 4, 5 different batches, so they have the pilot standardization samples with them. And once we get to plant, it moves much faster because they have already had experience with what's going on pilot. So the validation process of maybe 2 batches coming out of the pilot, of the commercial plant, makes us get into the eventual commercialization of the product much faster. And the anchor customers that we select normally take up, a fairly sizable percentage of the monthly production.
Right. Okay. That's very clear. Thank you.
All right. Thanks.
Thank you. The next question is from the line of Raj Mehta from Equirus PMS. Please go ahead.
My questions have been answered. Thank you.
Okay.
Thank you. The next question is from the line of Dwanil Desai from Turtle Capital. Please go ahead.
Hi, thanks for the opportunity again. Two questions. So I think if I look at our revenue run rate, if we take out this plant shutdown, we are kind of close to 230-240 crore of quarterly run rate. And we have this, 40 crore additional revenue from the new specialty chemical, and then we are doing debottlenecking.
No, the 40 crore revenue from the new specialty chemical is not for one quarter.
Yeah, understood. I'm saying for the entire year, or for the entire capacity, not year, for the entire capacity. And then, we have this debottleneck capacity, and then we have second half of the next year, again, hydrogenation capacity coming through.
Yes.
So is it safe to assume that, we can do ballpark 1,100, 1,150 crore kind of a revenue next year? Is that a safe assumption to make?
So, I think you've got the quarterly run rate right in terms of the top line, with our current product portfolio, assuming the pricing. And like Dharmil has said, that if we complete, if we do an investment of between 150 to 200 crores by end of this year, with a ramp up needed of say 6 to 8 months, we should be looking at the numbers that you just said as a targeted number.
At 1.7x, correct?
Yeah. But 1.7x at full capacity.
At full capacity.
So right now we probably, if you are talking of end of next financial, we probably might not be in that full capacity zone. So I'm looking at what your numbers are doable.
Yeah. Okay. Got it. And second question, Dharmil, is on FNF side. So I think, typically what we have observed is that FNF industry and players generally grow in line with FMCG volume growth, right? So 5, 7, 8%, high single digit, early double digits.
Right.
So do we aspire to higher than that? And if so, I think you mentioned strong traction in Middle Eastern market on export side last call. So how do you see that segment growth panning out in next 2-3 years, given the inquiry pipeline that you have?
Okay, so I'll try and address this. I think to answer your question is the FNF side, the growth that we are seeing is coming from markets like the Middle East and the Far East. The India FMCG sector currently continues to be under pressure, and we will see, low single digits probably in the FNF for our Indian subcontinent business. But I think the Middle East and the Far East will, play a significant role in the growth of that vertical. Yes, we aspire for more than what the industry is growing at, but we would be happy if we are in the industry ballpark percentage. Hello.
Thank you. The next question is from the line of Rohit Nagaraj from Emkay Global. Please go ahead.
Yeah, thanks for the opportunity and good afternoon. So my first question is in terms of demand. So we have seen that the input cost pressure has been there. We have also taken the price hikes. So Dharmil sir, if you could just give us a sense about whether there has been an impact on the demand of any of the segments that we cater to, maybe on a domestic business or from the international business. Thank you.
Parag, you want to take this?
Yeah, so Rohit, like we have reiterated, I think demand across the segment looks pretty strong, primarily because, if you look at the penetration of the FMCG sector, except the fine fragrances business, the rest of the big businesses and the requirement for them across the board is increasing globally, point number one. Point number two, the China Plus One strategy still stays very, very strongly in place. Point number three, there are relatively less capacity additions happening in the aroma ingredient space, and we are amongst the companies who are working on multiple chemistries and multiple products. So I think the interest levels and the actual numbers on the ground stay very, very strong when it comes to the aroma ingredients vertical. When it comes to camphor, I keep reiterating and I keep hearing this from my team that people burn camphor in good times and they burn it more during the bad times. So although the competitive landscape might alter a little bit, but we are pretty bullish about the demand. There might be some pressure on pricing, but we are pretty bullish on the demand of the fragrance and flavor side, and on the camphor side, and on the fragrance and flavor side, I think Dharmil has already answered the question.
Right, got it. So the second question is on the volume front. So we have seen about 37% YOI growth during the first 9 months. How much of this would have been contributed through volume increase, and probably the rest would be through price increases? Thank you.
So I think it's a combination of both. I mean, when Dharmil said in his introduction remark that the average rate per kg has gone beyond the pre-COVID levels. I think Oriental now is getting into a very interesting phase where we continue to stay focused on the bulk commodity aroma ingredients, but are also now slowly making breakthrough in these mid-value and high-value generic specialty aroma ingredient space. And so, I probably would not have the exact numbers with me now, but I probably can share it with Anuj later, and you can take it from him. But I think this growth in terms of the top line or the volume is primarily driven by a combination of both.
Sure, got it. Thank you so much, sir.
And the medium and the high cost specialty.
Right, got it. Thank you, and best of luck, sir.
Thank you.
Thank you. The next question is from the line of Amar Maurya from AlfAccurate Advisors. Please go ahead. Ms. Amar Maurya, your line is unmuted. You may please go ahead with your question.
Yeah. So first thing, sir, I have a couple of questions. Number one is, in terms of your the camphor business, which was largely shut down, so broad impact would be around 30 crores, right?
Correct.
Okay. Secondly, when you say the recovery of the margin, and you already took a price hike, so should we see that recovery in the gross margin should happen from fourth quarter?
I mean, we aspire to do that, and that's the reason why we are kind of working on it. And like I said, that assuming that all the other factors remain stable, then the advantage of the price hike and the kind of stabilization of the input costs at these higher levels, or some of them coming down, should give us the desired results in Q4.
Okay. And sir, your hydrogenation plant will come in Q4, right, of this year?
Correct. Q4 of 22-23, not this year.
Okay.
So not now. It's almost 9 months from now, 9 to 12 months.
Okay. And now currently, new capexes would be what, that greenfield, that single plant come, and then brownfield expansion, which you did in November 20, and now the 6 crore of additional debottlenecking, which we did at the camphor plant, right?
Correct.
So broadly, how much of the capex is already on the block?
We just mentioned that, no, Parag?
Yeah.
Actually, sir, in between my line got disconnected.
So 48 crores, 18 crores is from internal accruals, 30 crores we've drawn down, and we're expecting to utilize about 150 crores to 170. Was that the number, Girish?
Yes.
In this financial year.
Yes.
And that would be largely in Mahad.
That would be largely in Mahad.
Yeah, and this is like 2020 to 23, huh? I mean,
Yeah.
Yeah.
It's not like we will draw down everything tomorrow.
So 20 to 23 will cross 200 crores. Capex, right.
Got that. Thank you, sir. Thank you.
Thank you. The next question is from the line of Rajat from iThought Finance. Please go ahead.
So one question about your different segments. In one segment, when we are catering to different FMS companies globally, they are our clients. In the other segment, we are competing with them through our FMS segment. So there is some sort of conflict of interest if your clients in the aroma chemical side, want to look at it, like that. So how do you manage that?
Parag, you want to take this?
Yeah, so I think, historically, globally, as well as in India, the fragrance and flavor industry has been a very unique industry where, the fragrance and flavor compounding companies can compete with each other with a particular client. But when it comes to their aroma ingredients, they would probably end up buying the aroma ingredients from each other. So, when we become active in the aroma ingredients, I don't think it's an experiment that we are trying for the first time. I think it's something which has been an inherent part of the F&F industry, because with, say, 2,000 line items of ingredients, it is virtually impossible for one company to backward integrate.
Sure, and we compete in several products with the F&F companies, even on the ingredients side.
Correct.
And on the fragrance and flavor side. And that is not ever has not ever been a issue when it comes to us selling to their flavor and fragrance division our ingredients. And we buy also. So we make a musk in our Baroda plant, which competes with one of our largest F&F customers. So they buy from us, and then they don't buy the musk from us. They compete on the musk with us, and then they buy several other materials where they don't have any competitive conflict. So it's not any more a factor in this industry, if that's what you're asking me.
Just one more line to what Dharmil said. In fact, it's an advantage because, unlike a typical linear chemical manufacturer offering an aroma ingredient, these global F&F companies would want to work with a company who has a fragrance background because they feel that we understand the olfactive nuance of the ingredient, which is very important in our.
And we have not seen this, at least since we've got into the aroma chemical business. We've never seen this to be an issue.
Sure, and you're saying it is a practice across the. Everybody in the industry is comfortable with this practice, right?
Correct, absolutely. And they do it even on a global scale where the top 4 or 5 buy from each other and compete with each other. And that's because of the nature of the beast. We have over 4,000 ingredients that we use on the flavor and fragrance side. So nobody can make them all.
Correct. Understood, sir. Thank you so much.
The next question is from the line of Aman Vij from Astute Investment. Please go ahead.
Yeah, good afternoon, sir. First, just a suggestion. So we had this 20-day lockdown. So normally company informs the investor in between or someplace before the results itself, so that market is much more prepared. This was different from the normal shutdown of 5 to 7 days. So maybe as a practice, we can also start doing this kind of disclosure.
Sure. Sure. Make a note of that, please.
Yeah. And now on to the question. So first question, sir, when Girish sir was also talking about that we have a very healthy mix of spot and long-term contracts, more towards long-term contracts. So sir, we had some pricing issue in Q2 also. So we were expecting that by Q3 some of the price pass on should have happened. But it has taken like more than 2 quarters. So if you can explain that, is it because of some of the long-term contracts it's very difficult to pass on, or it takes time to pass on? So what is the reason of lagging for 2-3 quarters versus say in the next quarter itself? 1 quarter we understand things can happen. So if you can explain that.
Yeah. Thank you. Parag?
Yeah, sure. So I think Aman, the input costs going up were definitely factored, like I said, in our contracts which we did for H2 2021. But there was a substantial jump in the input costs in Q3, which were not anticipated and which suddenly came out of the blue when these, China electricity crisis hit, and in the month of September, when for the China Day, things were shutting down and nobody was knowing when the factories are going to open up. So there were, like I said, that these 2-3 quarters have been extremely unprecedented, where every time we have micromanaged and course corrected, there have been certain external factors which have been way beyond our control. which have had an impact. So in that situation, we have ensured two things: that we ensured that our relationship with the customer stays intact, and we have kind of conformed to all the contracts which we had with the customers. And that has really helped us, build that rapport with the customer, that when we went with a genuine price increase again, I mean, they have kind of welcomed it. But to answer your question, there have been factors which have been impacting not only us. I think these have been impacting overall the whole chemical industry, and so I think we are course correcting as and when we face a factor. Otherwise, we try our best to get the maximum value out of the contracts.
So, Parag sir, correct me if I'm wrong. So, Q2, whatever price fall had happened, we were able to price rise. So, we were able to pass on to Q3, but there were, in addition to Q2 rise, there were further rise in Q3.
Absolutely.
We will be passing
Absolutely. And those rises were substantially higher than what we had expected, in what we had experienced in H1.
Okay. That makes sense.
Yeah, absolutely.
Second question is on the camphor market and the competitive scenario, which you have briefly talked about, that there are other players who are also putting in capacities, and some are also putting capacities in the pharma side. So if you can briefly talk about what is the current market situation in terms of pricing you are seeing, not only in spot, but also in, say, long-term MNC contracts, where I think earlier there was very less competition, because most of the other players were in spot market, while we had the unique position of being in long-term contracts also.
Correct.
You can talk about the impact of increased capacity by the new players or by competitors on the long-term contract side also. Are we seeing increased competition there, or some kind of pricing pressure there also? If you can talk about that.
Sure. So correct. Like Dharmil said, as of now, we do not see any kind of significant impact in terms of pressures. We'll have to wait and watch.
Even with competition, we don't see this currently. No.
Correct.
And Dharmil sir, you are seeing no pressure in both the spot or long term, or you are seeing some pressure in spot and no pressure in long term?
No, like Parag has always maintained, Q4 we've been able to pass on most of the price increases, and we've not had any challenges in doing that, except the challenge continues to lie on the raw material side. So in terms of future capacities and the products that we manufacture, that we are feeling competition today, the answer is no.
And just to add one quick line, on the camphor side, as of now, we are not seeing any price pressures either in local or in exports. We'll have to wait and watch.
Correct.
Sure. And finally, if you can talk about the current market size.
I'm so sorry to interrupt. May I please request you to rejoin the queue for your follow-up?
Sure. I get that.
Thank you.
Thanks, Am.
The next question is from the line of Ankit from Bamboo Capital. Please go ahead.
Thanks for the follow. If you can highlight what will be the proportion of bulk chemicals and bulk aroma chemicals and specialty aroma chemicals in our aroma chemical sales currently, and how do you see this mix changing over the next 2-3 years with the capex coming on stream on both brownfield and greenfield side?
Parag, I think this has been covered in the past.
Correct.
So if we're running on time, Anuj, I don't know whether we can request a reference to some of the paperwork or the investor call earlier, which gives the answer to this question.
Sure, we can answer it to him separately later.
Sure.
Thank you.
Thank you. The next question is from the line of Aman Vij from Astute Investment. Please go ahead.
Yeah, thanks for the opportunity again. So, sir, I was talking about the camphor market size. If you can talk about what is it currently in India and outside India, and how is it growing, and what is our latest market share? If you can talk about those things.
I think most of this has been answered except the market share. So, Parag, you can brief.
Yes, I think, Dharmil, to be very honest, we have tried to do this experiment many times in the past, but because of a lot of unorganized players, a lot of imports, there are too many ifs and buts to really look at what is the size of the market. And so, we normally focus our energies, Aman, on looking at how we can sell our current capacity and the capacity that is going to come in the future.
Correct. And I think the numbers of the market size, etc., again, Anuj, have been given in the past, including the expected growth numbers, etc., if I remember correctly.
Yeah, but these are, again, as Paragji said, very, there's no...
They're fluid, yes.
Yeah.
So, I think, Aman, for us, we more focus on what we can do, and, probably be pretty confident about selling our capacity.
Sure, sir. Perhaps let me reframe it in another way. So what kind of volume growth do we specifically see in this camphor whole division going forward?
So, like I said that, again, you're trying to rephrase it, but I'll probably give you, because there's no standard template as to what will be the CAGR growth, what have been the volumes in the past, and I've never seen a study which has been done to really look at those numbers, because there are a lot of numbers in between, which are very difficult to really compute.
And to answer your question, the current capacity of camphor that we have in Bareilly is completely sold out. Okay. The additional capacity which will come in Mahad, irrespective of the competitive landscape changing, we are confident that we will be able to sell it.
Correct.
And so when you had talked about we'll take like maybe roughly 7-8 months to fulfill our new capacity. So this is also applicable for camphor.
No, I think it's over a period of time, as we've explained in this call. The additional 150 crores odd that we would be putting into Mahad over the next 12 to 14, 16 months, whatever they've mentioned. The product mix of where that money is going, we are not, we're not at this point disclosing for several reasons, but in the long term, camphor will be part of that. So we would not feel comfortable going into specific products.
Sure, no worries. Thank you for the answer.
Thank you. Ladies and gentlemen, that was the last question for today. I would now like to hand the conference over to Mr. Dharmil Bodani from Oriental Aromatics for closing comments. Over to you, sir.
Thank you so much. Thank you all for participating in this earnings call. I hope we have been able to answer your questions satisfactorily. If you have any further questions or would like to know more about the company, we would be happy to be of assistance. We are thankful to all our investors who stood by us and also had the confidence in the company's growth and plans and focus for the future. And with this, I wish everyone a great evening. Thank you.
Thank you very much. On behalf of Oriental Aromatics Limited, we conclude today's conference. Thank you all for joining us. You may now disconnect your lines.
Thank you so much.
Thank you.
Thank you.